Hello everyone, welcome to today's session. So today what we are going to do is, in the last session we completed unit number 2. Now we will be starting with the unit number 1. Okay, so with respect to unit number 2, before we proceed and deep dive into unit number 1, any doubts, any questions? Any doubts, any questions? No? If no doubts, then let me ask few questions from you guys. Like, a quick revision sort of what we discussed in the unit number 2. So, can anyone tell me in unit number 2, when we were talking about NBFC, which is the relevant section under which the NBFCs are required to get themselves registered with the RBI? Very
Sir,
good, Ayush.
45 IA.
Yes, very good. 45 IEA. Absolutely correct. Second, there are two type of classification we discussed about the NBFC. So, which are the two type of classifications? Category, basically. I'm not asking the type, but the category. Two category of classifications.
Functional wise, layer
Two
wise.
category of classification. Absolutely correct. Functional and the layer. So when I talk about the layer wise, can anyone tell me the scale based or layer wise classifications?
Base layer, middle layer, upper layer, top layer.
Absolutely correct. Yes. Base, middle, upper, and top. So which NBFCs are required to be classified as a upper layer?
Top 10 NBFC on the
Very
side.
good. Yes, very good. Top 10 NBFCs. Absolutely correct. What was the tier 1 capital ratio for the gold lending NBFCs?
12%.
Very good. Absolutely correct. And whether perpetual debt instruments are allowed for all NBFCs for the calculation of own funds?
No, sir.
So if not allowed, then for which category? If not allowed for all, then which category is there? Very good, Ayush. So which category, for which category it is not allowed? Quickly, for which category it is not allowed? Anyone? Okay, it is not allowed for the base layer. Perpetual debt instrument, you cannot count it for the base layer. Tier 1, Tier 2 capital, you cannot. Even for the own funds. Okay. Now, when I talk about gold lending, NBFC primarily engage in the gold lending jewelry. Okay, lending against gold jewelry. How will you identify that NBFC? What was the criteria for that NBFC to be classified? Let's say if there is an NBFC, what I will look into to say that this NBFC is engaged in lending against gold jewelry. Anyone? What I will look for, which classification or criteria I will look for to say that this NBFC is primarily engaged in lending against the gold jewelry. Anyone? No? Very good, Leela. 50% or more of their financial asset is based off such loans, that is loans against gold jewelry. Okay, very good. One last question that I would ask is, perpetual debt instrument is allowed for the NBFCs other than the base layer. So for allowed for the middle layer and for allowed for the upper layer in calculation of tier 1 capital. But there is a restriction that you cannot include perpetual debt instrument amount more than this amount in tier 1 capital. What is that restriction? Can anyone tell me? How much perpetual debt instrument I can classify or I can add in tier 1 capital? So what is the maximum cap on the perpetual debt instrument which can be included in the tier 1 capital for other than the base layer? Come on, quickly. Anyone? This should be easy. No? Okay. So it is basically 15% of the tier 1 capital of the previous year. I can include to the extent of the 15% of the aggregate tier 1 capital of the previous year of this particular company. I cannot include beyond that. Yes or no? I think everything vanished. Lecture change, everything gone.
Sorry, sir. I responded to BOS ICAI instead of your name.
Okay. Not an issue. So yeah, 15%. Yes. Very good. So that is the 15% amount. That's basically the thing is that we have to remember all these things, all these numbers in order to understand how the calculation of tier 1, tier 2 capital happens. Quickly, one more. What is the revaluation? How much revaluation reserve I can take in tier 2 capital? How much revaluation reserve I can take into in calculation for tier 2 capital? No, Payush? No. How much revaluation reserve I can take in calculation for tier 2 capital? Anyone? Revaluation reserves are to be taken at the discounted rate of 55%. Discounted rate of 55%. So I will take revaluation reserve at 55%, which is the discounted rate for the calculation of tier 2 capital. Clear? Any doubt? Any doubt? No? Okay. So this was something we discussed about the unit 2. That was about the special features of audit of NBFC. A quick revision that we about the topic. Now we will deep dive into special features of audit of banks and non-financial company. But now we will focus on the banks. Okay. Now we will focus on the banks area. Audit of banks. Okay. So the first question I usually ask with respect to audit of the banks, that when we talk about audit of the banks, which basically what things you think about when you do the audit, like what are the type of reports that you have seen, or what is the format that you have seen, anyone can tell me about their experience of the bank audit? What type of audit report or what type of reporting you do?
LFAR report, LFAR.
LFAR, yes, very good. Apart from LFAR, have you seen any other audit report for the bank? Have you seen any other audit report of bank? Okay. Now tell me, which are the laws do you think are applicable to a bank? Which are the laws which are applicable to a bank?
There are so many laws and regulation applicable to banks, like Banking Regulation Act,
For example.
then Companies
Mhm.
Act, RBI Act, and like Cooperative Society Act, SEBI Act, PMLA Act, Information Technology Act. Likewise, we have
Yes.
many
So
acts.
if let's say, for example, many acts are applicable, perfectly fine. For example, let's say Companies Act. If Companies Act applicable, then do you think the reporting under Section 143 is applicable?
Yes, sir. 143
For the
also is
bank audit, do you think applicable? Okay. I will show you a audit report of the bank. Okay, available in the public domain. By this way, we will understand how the different audit reports are prepared, because most of you are familiar with the LFAR, but very few of you have seen the audit report, the statutory audit report of the bank. Again, this is available in the public domain. You can go and check. So don't focus on the name of the company. Okay. So this is the independent auditor's report. Okay. Now this is for a bank, which is limited. So this is listed. It's a bank and it's a company. So when I say company, Companies Act applicable. When I say listed, LODR applicable, or SEBI regulations, whatever it will be applicable. Okay. When I say bank, Banking Regulation Act applicable. Okay. So banking regulation, Companies Act, LODR, there are all other rules and regulations will be applicable. Now, when I say Companies Act is applicable, so 143 will be applicable. When I say LODR, all the listing requirements, quarterly review, everything will be applicable. Plus your Banking Regulation Act will be applicable. Companies Act will be applicable. So the way we have an audit report for the company, similarly you will see an audit report for the bank. Opinion, basis for opinion, key audit matters. What was the standard for the key audit matter? Which essay was there?
501.
Quickly. No.
Key audit matter, sir. 501.
No. Key audit matters, which standard? Quickly.
Sorry, 701, sir. Instead of that, I said 501. 701.
Yes. 701. Key audit matters. Okay. So key audit matters are taken care by the SA 701. Okay. So key audit matters, the way we are required to give. Okay. Then you have information, other information. Then your responsibility of management, auditor's responsibility. And if you'll see, all the responsibilities are the same the way they are in the audit of a company. Okay. Then there are other matters. Other matter paragraph. Which essay? Quickly.
706.
Very good. 706. Okay. Now comes this part, legal and regulatory requirements. The way we have in the Companies Act, all those things will be here. See, 143.3. So 143.3 reporting, Rule 11 reporting. Okay. All these things are there for the reporting. Plus, this is the additional part coming from other laws and regulations. For example, Section 133 of and Section 29 of the Banking Regulation Act, Section 30 of the Banking Regulation Act, okay, Section 197 of the Act and 35B2A of the Banking Regulation Act. Additional reporting for the managerial remuneration, for books of accounts, which is there by other law. But what we have discussed will be there. Now tell me, will I have a CARO for this company? The way I have 143.3.
No, sir. CARO is not applicable for banking and insurance company.
CARO is not applicable. And why? Exemption, basically. So CARO is not applicable because there is an exemption to the banking company. Okay. So you have report on the basically all the other things are there, but you have the report on the internal financial controls. You have covering the audit report covering all the relevant provisions of 143, Rule 11, everything. But you will not have a CARO because CARO exemption. What was the CARO exemption? To whom the CARO is not applicable? Quickly, CARO exemption.
Sir, banking company, insurance company, one-man company, small company.
Banking, insurance, one OPC, small and
Section 8 company.
Company. Yes, very good. Section 8 company. Very good, Sarah. But there is one more exemption. Apart from this, there is one more exemption for the CARO. Which one? Which is what? Which is that exemption?
Private limited company. There is certain limits are there.
Conditions. Yes. So there is a private limited exemption with some conditions. That is P1, D1, R10. Paid up share capital 1 CR, debt below 1 CR, revenue less than 10 CR. Then only you can get the exemption. Otherwise, you cannot get the exemption. Okay. So BIOS 8 and private limited P1, D1, R10 is the CARO exemption. Okay. Rest everything, if you see, is same. Now coming to the part where the financial statements are prepared. Which division is applicable for financial statements? Which schedule of Companies Act will be applicable for the financial statements? Quickly.
Sir, banking, there is no schedule is applicable to banking. See, we have that division, schedule 1, 2, 3 is there. But schedule 1 is pertaining to AIS followed company, 2 is Ind AS, 3 is NBFC, but nothing is there in the Companies Act.
So from where the format is coming for a bank?
Sir, bank is coming from the Banking Regulation Act 1949. There is a schedule 3 from where the financial reporting framework is applicable for the banking.
Okay. Now, over here, there is a small correction. Your answer is absolutely correct. Banking Regulation Act. There is a schedule to the Banking Regulation Act. But there is a small correction on it. Most of the times, what we do is in exam also, the way you said, we write in this a similar way. Okay, that Schedule 3 of the Banking Regulation Act, it is applicable, but that is slightly incorrect. That part. Why I tell you? If you see the Banking Regulation Act, okay, there is something I'll show you in the Banking Regulation Act, which is different. Okay, just a minute, let me open.
Yes, sir. There is a Form A, Form B. Form A is balance sheet. Form B is profit and loss account.
No, that is fine. Yes, but see, it is third schedule. It is named as the third schedule. Okay, so it's not the Schedule 3, it's the third schedule. If you see the name of the schedule, it's third schedule. That means when you need to write a question on the banking, from where the particular format is coming, you need to mention third schedule rather than the Schedule 3. Schedule 3 is in the Companies Act. Third schedule is in the banking regulation. And that's where the difference is, because if you incorrectly quote a schedule, that's a problem. Okay. This is third schedule of the Banking Regulation Act under Section 29, not Schedule 3. Remember, it's not Schedule 3. It is not written like that. No, it is written the third schedule of the Banking Regulation Act, or under Banking Regulation Act, which prescribes the Form A for the balance sheet, and this is Schedule 1 for the capital. You might have seen already in intermediary various different schedules. Because if you write Schedule 3, it will be Schedule 3 deposits. This one. So you cannot write Schedule 3. Schedule 3 is for deposits. So you have to write the third schedule. Okay. And Form A for your balance sheet with all the schedules, and Form B for your profit and loss account, coming from the Banking Regulation Act. So this format of financial statement is coming from the Banking Regulation Act. That is the third schedule under or in connection with Section 29 of the Act, Banking Regulation Act. Clear? Any doubt? Any doubt? So, again, you know the format: capital, ESOP, reserve surplus, deposits, borrowings, other liabilities. Okay, and then asset wise, again, in the form of liquidity: cash, bank, investment, advance, fixed deposit, and others. And then you have contingent liabilities. Okay, that is the one thing that is applicable to a bank. So we understood there is a banking regulation, there is a third schedule which is applicable to bank. Form A, Form B that we have seen. Now with respect to accounting standard, which accounting standards are applicable to bank? Which accounting standards are applicable to bank? NDS, AS, different altogether standard, public accounting standards. Which standards are applicable to bank?
Sir,
Anyone?
accounting standard is applicable, sir.
Not NDS?
Yes, NDS. If it is more than 250 crores, definitely NDS is applicable.
So NDS is applicable. Anyone else? Which accounting standards are applicable to a bank? NDS, AS, or public accounting standard?
I think till now there is no notified, not notified. It's only deferred. But however, we could see the disclosures.
Disclosures, as in, sorry, I did not get disclosures means which disclosures you're referring to?
Accounting standard disclosures.
Okay. So, it'll come. Okay. Let me give you answer for that. See, as of now, accounting standards are only applicable. NDS is not applicable. It has been defined. Okay. And basically, when we have to understand the bank, what laws or regulations are applicable to the bank, how accounting is done. There was something similar in your NBFC. What was that? In NBFC, there was something similar that we saw that is applicable, that talks about accounting portion, that talks about something on provision. What that was called? Anyone?
Disclosures.
No, not disclosures. There was something that we saw, some type of, a chapter was there which had a specific name, which was talking about asset classification, which was talking about your income recognitions. We used a term to classify or to name that chapter.
Stage 1, stage 2,
Anyone?
stage 3. Stage 1, stage 2, stage 3.
So those were known as the prudential norms, prudential regulations that defined how a particular accounting for a particular asset will be done. Very good, Sarah. Prudential norms. We are talking about prudential norms in NBFC. Now tell me one thing. In bank, do you think we will have prudential norms? If you have gone through the chapter, you might be aware already. Do you think we have prudential norms in banks?
Yes, sir, we have.
Okay. So I'm showing you something now. Now there are two things I want to show you for time being. Okay. This is the 1st April 2025 Master Circular, which is applicable to all commercial banks, including regional rural banks. Why? Because for them, there is a separate circular. There is a separate master directions or master circular applicable for them. Different type of banks have different type of regulations. For example, cooperative banks, for them regulation is different. I'm talking about commercial banks as of now. Okay, commercial banks, you have these regulations applicable for commercial banking. That is the one thing. Second is when I talk about basically prudential norms or regulations, yes, to banks they are applicable. There are prudential norms or prudential regulations for bank, and that particular prudential norms or prudential regulations are being like applicable to commercial banks, to regional rural banks, to payment banks. A lot of banks are there in that particular scenario. Now, one just information, if you go on the RBI website and if you go through the norms and regulations, you will come to know that on 28th of November, just few days ago, 3 days ago, RBI issued a set of 389 if I'm not wrong, 389 master directions, which cancelled all the previous 9,000 circulars. So there was a very big change that occurred on 20th November with respect to all the master directions which are applicable to NBFC, which are applicable to the banks and everything. However, that is not applicable to you. That will not be applicable for your exam for May 26. Okay. So for us, whatever position it was there before that particular change of 20th November 2025, that is applicable to us. That we need to go through and that we need to understand. Clear? Any doubt? So this is basically which was issued on 1st April 2025. We are not taking any other master circular because the latest one will be new one which is not applicable to you. Okay. Now, when I talk about this particular master circular, basically, what it covers, it covers various things. It covers income recognition. It covers out of order, non-performing asset classification, provisioning norms. Okay. And it covers a lot of additional requirements with respect to if there is a specific area. Okay. For example, credit risk management, specific with respect to the due date or repayment of date, board oversight, willful defaulters. Okay, a lot of things are there in this particular master circular. Based on this, we will try to understand what is applicable and how it is applicable to a bank in relation, in comparison to the NBFC. Why? Because there is a reporting requirement behind this. There is a detailed reporting requirement. The way we had in NBFC, similarly, we have a reporting requirement for the purpose of banks. But before that, we need to understand the provisions or the laws or regulations which are applicable to a bank. Then only you can go and perform the reporting. Then only you can actually go and see, okay, this is something how we need to report. This is something we need to report. And you will only understand when you understand the law specifically. And in banks, more than reporting is about the auditing part, because there are multiple different things that we need to audit. We need to understand. Let's say, for example, bill discounted. Let's say example for loans given. So all these areas are critical areas, and you need to understand how to audit those areas in order to, again, what is the end result of those of that particular auditing? The end result should be that we are able to report. Clear? Any doubt? Okay. So let's discuss about. First of all, I will show you how and what similarities there with respect to these requirements and directions. Second, we will see a very important thing with respect to bank. Okay, that is how an auditor has to perform the audit procedures in a separate and different areas. Once we perform audit in different areas, we will collect the evidence, we will collect the information. That evidence, that information will help us in order to perform the reporting. Okay, so we will discuss various different areas. Okay, in case of auditing, in case of banks. Now, let's go to first definitions, because that's the main area. First, we will start with the classification of asset. Classification of the asset, the terms that you understood in case of NBFC will not change. Yeah, the only part may change will be, for example, now instead of 12 months, 18 months, there could be some different criteria. But non-performing asset means a non-performing asset. Clear? So let's start with the first asset classification. So in case of banks, we have something called asset, type of assets. Now, type of assets, what were the type of assets in NBFC? Quickly.
Performing asset, non-performing asset.
Okay. In case of non-performing,
Standard asset, substandard asset, then doubtful asset, less than 1 year, 1 year to 3 years, more than 3 years, then loss asset.
okay, standard asset, doubtful asset, all those type of. Yes, Sarah, very good. So we have standard asset, we have substandard asset, we have doubtful asset, and we have loss asset. Now, my question to all, what was the definition or criteria for the standard asset? How will you identify the standard asset? How do you identify the standard asset?
Sir, if the account is on
Anyone?
out of order, sir, if the account is on out of order more than 90 days, then it will be classed as a non-performing asset. The substandard. The standard means it will be less than 90 days out of order.
Hmm. Okay. Anyone else? Anyone else with some different answer or something further to add? Yes, no. Am I audible?
Yes, sir, you are audible, sir.
Am I audible to you guys? Yeah, okay. Sometimes it appears that I'm audible or not. Okay, so not an issue. Okay. So let's talk about the classification with respect to various type of assets. Now, the way we had classification in the NBFC, similarly we have the classification of asset in the case of banks. And it is, if you see, like when we will discuss now the classification, if you'll see, it is pretty much similar. It is similar type of classification. You will not find and a lot of differences when it comes to the classification. So, for example, when I talk about NBFC, what was the NBFC classification for the substandard asset? What was the NBFC classification for substandard asset?
Sir,
Anyone?
middle layer there is a, sir, middle layer there is a different 15 months is there, and 90 more than 90 days to less than 15 months, then it will be standard asset. For the base layer up to 31st March 2025, there is a what do you call the glide path is there. 31st March 2024, there is a 50 days. Then 31st March 2025, it is a 120 days. From 31st March 2026, it will be the 90 days. 90 days to 12 months.
Yes.
For base layer. But
Yes.
for banking company, it's a straight away 12 months only there. That 15 months category is not there in banks.
Okay, very good. Yes. For banks, if you see, it's standard 12 months. Substandard asset would be the one which remain the NPA for a period of 12 months. For less than or equal to the period of 12 months. That's the substandard. If you think of NBFC, it's just like an ML. NBFC ML, middle layer. Okay. So NPA, if a substandard asset is an NPA for a period of less than 12 months, less than equal to 12 months, it's a substandard. Asset becoming NPA and basically it's due, okay, with respect to with respect to the amount, principal, whatever those things are. Clear?
Yes, sir. Here we will say out of
So
order.
that is the one criteria.
Here we will say that overdue we will call it as here is out of order. In NBFC we will say the overdues. The wording will be different.
Yes, yes. See, again, when I talk about overdue, out of order, we will come to that, but there's a small change over there that we need to discuss. But yeah, you are pretty much on the track. So that was the with respect to the NPA, how NPA becomes. So there are things we will look into that. Now, second, when I talk about doubtful assets, it's similar. Like remember in NBFC we had anything NPA for more than 12 months, it will be a doubtful asset. Similar, same over here in the banks. Nothing different over here. What was the criteria for the loss asset? Anyone?
Loss asset is the internal auditor or external auditor. They identified classified as a loss asset, then that will be treated as a loss asset.
Absolutely. When an auditor classifies a particular asset as a loss asset, okay, and the amount is not written off, in that case, that particular amount can be classified, will be a loss asset. Similarly, over here, if a asset, which is one identified by the bank, internal or external auditors, or RBI inspection, and which has not been written off, okay, wholly, which is not written off wholly, which is uncollectible, okay, and there is no recovery value and nothing, that particular asset will be a loss asset. So again, you can say asset identified by the bank, internal or external auditor, asset identified by bank, internal, external auditors, or RBI. Those assets will be classified as a loss asset. Clear? Okay. Now, that was the classification. Now, coming to the part when we will talk about NPA. What is NPA? Okay. Can anyone tell me now what is NPA over here? What is the definition of NPA? What was the definition of NPA in NBFC?
If the account
Definition of
remain,
NPA?
if the account is remain out of order for more than 90 days, then it will be classified as NPA.
If an account remains out of order, then it will be classified as an NPA. Yes, absolutely correct. Absolutely correct. So, if accounts remain out of order for more than 90 days, you will classify that as NPA. But there is one more thing. When there is a loan or advance, if the advance or loan is remaining unpaid, that will also be classified as an NPA. So either it is unpaid or out of order. Out of order, the term when I talk about out of order, it is used for cash credit or overdraft. That is the meaning of out of order that we need to understand. Okay. But for the other category of assets, loan, bills, installments, principal or interest, if that is outstanding for more than 90 days, that becomes a NPA. So when I talk about NPA classification, if a particular asset, okay, where you have an installment, which may be your principal plus interest or any of them outstanding for more than 90 days when it became due, that particular asset will be now called as an NPA. it was overdue for more than 90 days. In respect of a term loan, when I talk about term loan, it is overdue. This portion is overdue. Now, I'm talking about this installment, I'm talking about term loan. But there are other type of loans also. There are other type of facilities also. So in case of a cash credit, CC, or overdraft facility, the NPA classification will work with respect to when it is remaining out of order. If the account is an out of order account, that means it is NPA. Now we will understand what is out of order, but as of now, think of account being an out of order in case of cash credit and overdraft. So it is out of order. And we will see what it means. In some time, we will see what out of order means. Okay. Then, when I talk about other than the term loans, other than the cash credits and overdrafts, so there are, for example, loan on crops, agricultural loan. Okay. So that is for the long duration crops, for the short duration crops. There are, what you can say, loan, agricultural loan, which is given for the facility of the farming and crops. Now, again, it is depending upon whether it's a long crop or short crop. Now, in case of long crop, principal or interest outstanding overdue for one crop season. Over here, you don't have days. Similarly, in short crop, principal or interest overdue for two crop season. It is called as an NPA. Okay, it will be called as an NPA. Other liquidity facilities, 90 days. Derivative transactions, mark to market value of the transactions. If there is anything unpaid on those transactions, 90 days. Okay. Now coming to the part about out of order. When I can call a CC or a OD as an out of order. If the outstanding balance is in excess of my sanction limit or drawing power. If the outstanding balance, okay, is exceeding the sanction limit or drawing power. Basically, my drawing power or sanction limit is lesser than the outstanding balance. And this is continuing for 90 days or more. Okay. So if this continues for the 90 days or more, this particular CCOD will become out of order. Yes or no? Clear till this particular point of time, this point, that if a CC or OD in which the outstanding balance is in excess of the sanction limit or the drawing power for more than 90 days, that particular CC or OD will become out of order. And once it becomes an out of order, it's an NPA. But there is one more condition. There is one more scenario. Still, if let's say outstanding balance which is less than my drawing power, outstanding balance less than drawing power, but still I will call this an out of order. Because why? Because there were no credits for the 90 days or the outstanding balance is less than the drawing power, but the credits are not enough to cover the interest portion which is charged on this cash credit. So either I don't have, means no credit in account, or credit not sufficient to cover interest. If that is the case, and if this continues for 90 days or more, it becomes out of order. So I'm saying either there is no credit, or the credit which is there, it is not sufficient to cover the interest portion which is charged on this cash credit or overdraft facility. At that point in time, it will become out of order. Clear? Any doubt? Yes, no? So basically, let's say for example, this cash credit and overdraft facility is there. Let's say you are being assigned to audit this cash credit facility or overdraft facility. Okay, now you are going for the bank audit. You are assigned to audit this particular cash credit or overdraft facility. Okay, now what you will see, there is no amount for credit for more than 90 days. I'll classify as an NPA. Okay, I will classify that account as an NPA. But what if the accounts or the drawing powers are not appropriately calculated? What if the drawing power is assigned so much high that it is always more? Okay, what if the accounts, like before 90 days happen, the person is reporting a lot of amount and very next day he's withdrawing a lot of amount? It can happen, no? Like for example, let's say just before 1 day before 90 day, there was an outstanding amount of 1 CR, which was more than the sanction limit. What I did is I deposited 1 CR. It wiped off the entire outstanding amount, including interest and everything. Account became normal. After 2 days, I withdrew that 1 CR again. Don't you think that these kind of transactions and these type of things will change the account classification? Yes, no? So when we talk about auditing, so these are the things that we need to understand. So there is a concept called accounts being regularized near balance sheet date. Okay. Specifically these CCs and a lot of loans which are regularized near the balance sheet date. If an account has been regularized near balance sheet date, in that case, as an auditor, what we are required to do, we will see all those scenarios. That how to deal with those kind of accounts, how to report those kind of accounts, whether still that will be counted as an NPA or not. So we will see all of these things. Plus, there are accounts called with temporary deficiencies. There are accounts where you don't have limits reviewed. There are accounts which are kind of I would say upgradation is required, downgradation happens. A lot of things are there. So we will see all those accounts with respect to CC, term loan, and all those stuff. Okay. But as of now, first we will focus on the classification because that is very important. We need to understand the classification. That is the NPA. Clear? Till now, clear? Any doubt? Any doubt? Okay. Good. If no doubts, then yeah, good. Okay. Now coming to the part where about this classification, why we are doing this classification. What is the purpose of doing this classification? See, once we do this kind of classification, the way we did in the NBFCs, that we made provisions. Similarly, we are required to make provisions only. So once the classification is done, the next step is for the provisions. So we are required to provision for these different category of assets. And we will see there are specific requirement with respect to the provisioning, but we will see first general requirement, and then from there we will go with the specific requirement for the provision. Okay. Now, can anyone tell me what was the provision requirement for substandard asset in case of NBFC? I'm asking NBFC. Provision requirement in case of substandard asset in NBFC. What was that?
Sir, for substandard NBFC, for base layer, it's based on the what is called a clade bath and the less than 12 months category. There is a provision is 10%. Secured portion and unsecured portion is not there. For middle layer, it's 90 days to between 15 months. That again it's a 10% substandard asset.
Middle layer it was 12 months. NPA norms for the substandard asset for base layer it was
10%.
It was changing for the base layer. Yeah,
base
10%.
Layer 12 months.
Yes, 10%.
Yeah, base layer 12 months. Middle layer 15 months.
Yes, absolutely correct. Yes. So similarly, we have the provisioning norms for banks also. Okay. For banks, the provision for the substandard asset. Can anyone tell me what is that? What will be the provision over here?
Sir, here is a 90 days to 12 months will be classified as a substandard asset. Here, that's for secured portion is a 15%, unsecured portion 10%.
No, there's a change of there. So, a general provision on the secured portion. Okay, a general provision on the total outstanding, basically. So, general provision.
General provision is 15%.
On total. But when I say total, that is without making an allowance for the guarantee or securities. So without considering that, a general provision will be there for the 15%. But when I talk about additional provision, there is an additional provision on the unsecured portion. So if there is an unsecured portion in this total, so there is an additional provision on unsecured of 10%. So if there is an unsecured, that means if there is an unsecured substandard asset or loan, the provision will be at the rate 25%. General provision 15, additional provision 10, making it to 25% on the unsecured. But whereas if it is secured, it will only attract a general provision of 15%.
Sir, to clarify one thing, say example, one borrower took loan for 10 crore. To ease our example, in this case, is totally secured means is 15% only the provision will be there. Out of 10 crore, 5 crore is secured, 5 crore is unsecured. For 5 crores, 15%, remaining 5 crore will be 10%. Am I right, sir?
No. If there is a 10 crore which is outstanding, that 10 crore will attract a general provision of 15%. Now the unsecured portion, whatever is there, let's say 5, 4, 3, whatever unsecured portion is there in that 10 crore, that unsecured portion will attract an additional 10%. And that again 10% on that unsecured will be an additional provision.
Okay, which means for 10 crore, the total 15% will be first applicable. For the remaining portion, say example, out of 10 crore, if the 5 crore is unsecured, then for the unsecured portion, additional 10% will be applicable in addition to 15%.
Yes.
If it is totally unsecured, 10 crore also, 10 crore totally unsecured, 25% is flat.
Yes, 25% is flat because 10% general, additional, general 15%, additional 10% make it 25% on that unsecured.
Okay, sir. Thank you.
Sometimes, see, okay, now when I talk about security, sometimes the security are escrow accounts, which are available for the infrastructure lendings and infrastructure loans. So if there is an escrow account available, okay, if escrow account is available basically, okay, for infra loans, okay, so this additional 10%, or let's say for example, okay, basically this additional 10 will become 5%, so that will attract a total 20% provision. Okay, so if there is an escrow account available, that substandard will attract 20% instead of 25%. So this 25% will become 20% on that escrow account. If there is an escrow account available in front of your substandard asset. So there is a lower provision requirement for specific kind of accounts. Clear? Any doubt?
Sir, for escrow account, total flat 20%. Whether it is secured or unsecured, it's not a
so
matter.
If there is a substandard of which you have an escrow account, forget about general provision, additional provision, take direct 20%.
Okay, sir. Even it is unsecured also.
Because it is not properly secured. It is if the escrow accounts are not properly secured. See, it's an escrow account. It's not a security. As a result, that's why there is a lower percentage, but there is some amount, something in front of you. That's why a lower, but not even, it is more than the general provision because some portion is still unsecured.
Escrow account is nothing but it's a temporary deposit made by the before making the loan. They will keep it some portion out of it.
Yeah.
Okay.
For example, let's say in RERA, you might have already seen 70-30 accounts. Okay, 70% is to be from the buyer receipt, 70% will go in one account, 30% will go in another account. So these are kind of escrow accounts only. Okay, now that was for substandard asset in case of banks. Now we will talk about doubtful asset. Doubtful asset. What was the scenario for NBFC?
So NBFC again less than 1 year, 1 year to 3 year, more than 3 years. 20, 30, 50. If it is unsecured, then 100%.
Okay, up to 1 year.
20%.
1, 2, 3 year and more than 3.
I am talking about NBFC.
Yes, sir. NBFC. Now, in case of banks, instead of that, my 20, 30, 50, over here I have something different. It is 25,
25,
40,
100.
and 100. Yes. Now, more than 3 years, 100. If unsecured, this is I'm talking about secured. But if it is unsecured, then directly 100. Don't think further. The portion which is not secured or not covered by any realizable value of security, which is unsecured, directly 100%. Any doubt? Any doubt? Again, there are other scenarios also where a specific kind of asset might be there, other provisions might be applicable to them, but this is the general one we are talking about. Okay, these are the general ones we are talking about. There may be big projects, PPE projects. There may be other kind of scenarios we will discuss. We will not go into that much detail for those kind of projects. Okay. Now that is for the doubtful. What is for the loss asset? Anyone? This should be easy.
100%.
Loss asset. Very good. 100% provision. Simple, straightforward. 100% provision loss asset. Very good, Sarah. 100% provision loss asset. Similar to what we saw in the NBFC. Now coming to very important part. Now we will talk about standard asset. What was the provision requirement in NBFC for standard asset?
For base layer 0.25, for middle layer
for 0.4%. Now here, in case of banks, it depends upon the type of facility. In banks, it depends upon the type of facility. If it is the farm credit, if it is the individual housing loan, if it is the MSME loan, MSME lending or MSME credit, that will attract 0.25%. Commercial, real estate, that will attract 1%. Commercial real estate, that is CRE. Commercial real estate is CRE. Now I'm talking about commercial real estate, but that is housing, residential housing. That will attract 0.75%. There are other type of loans also. Okay. Over there, it will attract different rates. But other, let's say, generic category, other general category, it will attract 0.4%.
I think 5% also applicable. I don't know for which category. 5% also will be there.
That is for the restructured and loans provided for the specific areas where natural calamities happen. Over there it is 5%, and advanced restructured there is a 5%. But again, that's why I said we will not go into that much specifics. 0.25, 1, 0.75 and 4% are the rates which are there. Sorry, there is one correction. My mistake. Instead of MSME, we will write SME. Why? Because it's a small and medium enterprise. But when I talk about medium enterprise, not small and medium, small and micro. So this is small and micro. Small and micro. These are the small and micro. But when I talk about medium enterprise, that will fall under this category, other. So it will attract 0.4%. So micro and small 0.25, medium 0.4. Clear? Any doubt? Now there could be additional provisions at a higher rate, maybe prescribed by the banks, by the committee of the banks, or by the RBI. Then in that particular case, those provisions and those rates are required to be followed. For example, let's say if there is a provision, requirement on the lease asset, in that case, it may not attract 10% additional. Depends upon the type. If there is an additional rate prescribed on. So basically, these rates are the general rates that we are talking about, but in specific scenario, it may change. Clear? Okay. Now coming to a next part is about a part where we talk about where there is a cover given. ECGC cover. Okay, ECGC guarantee. Now what is this guarantee? Can anyone tell me? Have you heard about ECGC guarantee? What is ECGC guarantee? You might have seen a lot. If you have read the chapter, you might have come across this particular term a lot.
Is it export credit guarantee?
Yes. So if there is a guarantee provided by the Export Credit Guarantee Corporation for the outstanding advances which are classified as a doubtful or substandard, in that case, how to consider that? How to consider that portion? Will you count that portion as a secured portion? Will you make a provision as a secured or will you make provision as an unsecured?
Unsecured?
So you make a provision as an unsecured on that. Okay. Anyone else with a different answer? Anyone? No? Okay. Let me explain with an example. Now, there is a provision that is advances covered by the guarantee. Okay. And how these are required to be considered. A small example will help us to understand how these guarantees are basically looked for. Advances covered by ECGC guarantee. Okay, let's say outstanding balance is 4 lakh, 4 lakh rupees. Yes, 4 lakh rupees. The cover, which is ECGC, is 50%. Okay, advance, outstanding, or NPA or overdue. Overdue let's say doubtful, category is doubtful for 2 years. It has remained doubtful for 2 years. Secured portion or security held. Security. Let's say the security we are talking about realizable value. Okay, NRV. I'm talking about security NRV, realizable value of security, which is rupees 1.5 lakh. Now, how much provision you will make on this? If there is a question, let's say provision. What is the amount of provision that you will make on this? Take 2 minutes, go through the calculation or perform the calculation and tell me the answer. What provision you will make?
So is it 1.25 lakhs?
The provision amount? No. Provision amount is not 1.25. Anyone? What is the provision amount?
So provision will come
Hmm.
1 lakh 1,000, sir. 1 lakh 10,000.
No. No. No.
50,000.
I'll tell you. So, with respect to this guaranteed portion, again, this is a government guarantee. Okay. That cannot go as an basically what you can say doubtful, or it cannot become NPA. It's a government part. Okay. So, what will happen is I have a 4 lakh rupees as an outstanding balance. I will reduce this value of security, that is 1.5 lakh. The total value that will be there, which will be unrealizable value, unsecured portion, that is 2.5 lakh. This is unsecured. The guarantee is always provided on the unsecured portion, the credit guarantee which is there. Now, when I talk about 50% is the credit guarantee. So, out of this, 1.25 lakhs is covered by credit guarantee. And this portion cannot become outstanding, or it cannot be counted as an overdue. Because if there is a credit guarantee in front of any of the asset, that particular portion cannot become overdue or cannot become doubtful for the purpose of provisioning. Understand that. For the purpose of provision, I cannot make a provision on this number. Reason because it's something, government part. The government has to pay an amount. How can I say there will be a, provision required on the amount that is to be paid by the government? I cannot apply any provision on that. So that is a one portion. This will be out of provision. Now, rest 1.25 lakhs. This is unsecured. What was the rate on the unsecured?
100%.
What was the rate of?
Doubtful for 2 years, no. It's a 40%.
But that's
40%.
secured portion.
That will come to an amount of 0.6 lakhs. Now coming to the rest of the portion, this secured portion, which is realizable value. Now on secured portion, what is the percentage? Sorry, my mistake. This is not 40%. Yeah. Secured will be 40%. This is unsecured. It should be 100%. My mistake. This is 100%. And this 1.5 is secure. This will be at 40%. Okay. And this 100% will become 1.25 lakh provision, and this 40% at 1.5, it will go to, I think, 0.6. 1.5 into 4. Yeah, 0.6. So 60 lakhs, 0.6 lakhs. So the total provision will come to 1.85 lakhs. Total provision. Clear? This is how I need to consider the advance covered by the guarantee.
Sir, here why
Any
we are
doubt?
not taking for portion the ECG coverage 50%. Why we are eliminating that 50% fully?
See, when I take a provision on the secured portion, I take a less provision saying that although it is secured, but there are chances of that I may not realize the security because of some XYZ reason. Okay. So when I take a provision on the secured portion, I am saying that there are chances that I may not realize the value of the security. But when I talk about the credit guarantee, this is the guarantee given by the government. There is zero default risk. So the provisions are based on the default risk. That's why when I say credit guarantee, there is a zero default risk. That whatever guarantee which is given by the government, I will realize 100% of that. That's why you do not make any provision on that particular amount.
Sir, here in NBFC, we studied like if it is more than 90 days, and if for state government, if it is more than 90 days, 100% will be taken. Like that, the central government will be the zero, the asset, asset. Like that, is there any provisions is here on the government guarantee?
No, reason because NBFCs, this first of all, credit guarantees are not extended to everyone. There are specific case scenario which are given for the export. Now, when I talk about loans provided by the NBFC do lend, but they do not lend in case of, I think, that much into the export and that much into that particular area where these guarantees come into the picture. More probably, the banks are the ones who deal in this area. That's why you have a specific requirement over here. So in general scenario, most of the NBFCs do not deal in these kind of loans. You can say as of now.
Sir, here one more question is that the ECGG is given the 50%. See, security already provided 1.5 lakhs. That's okay. But can I say that out of 4 lakhs is the 2 lakhs is that guarantees given by the government? See,
No. So guarantee is always on the unsecured account.
Okay.
Guarantee is always on the unsecured account.
Okay, sir. I got it clear.
Okay. Now this was advanced part. Okay, and this was NPA classification. Now the way we discussed about, basically, remember what is before NPA. So there is again same classification before NPA. We have one more type of classification, that is SMA classification. Okay, so before NPA you have a SMA 0, SMA 1 and SMA 2. That is up to 30 days. That is up to more than 30 days to 60 days. Then you have a 60 to 90 days. Okay. This is before NPA classification. So basically this SMA category of classification is used for reporting. Okay. On the loan accounts, on the accounts where there is a default. But there is an account called credit facilities. These are I'm talking about loan accounts. But there is an account called credit facilities, cash credit and what you can say, overdraft. Over there, you don't have any due date. When I talk about credit facilities, you do not identify any due date. And in case of credit facility also, how we identify the NPA on the basis of out of order status. Okay, out of order status. Over there, you don't have a 0 day basically. Reason why? Because I have to see that whether it is out of order for less than 30 days, more than 30 days, out of order for more than 90 days. So I cannot say that on a 0 day it is out of order. So over there, in case of a loan, amount was due, not paid, your overdue starts. In credit facility, it is not that simple. So that's why over there we have a SMA 1 and SMA 2 categories. We don't have a SMA 0 category. That is more than 30, but up to 60 and 60 to 90 days. So for credit facility, these are the two classifications, 1 and 2. Yes, Saminathan.
Sir, is that up to 29 days or up to 30 days? If it is up to 30 days, then 31 days to 60 days, 61
More
days
than
to
30.
90.
More than 30.
Okay,
See,
then
again, so when I talk about up to 30 will be SMA 0. 31 means more than 31, like more than 30, 31 to 60 will be falling under the category of this one, what you can say, SMA 1, and then 61 to 90 SMA 2.
okay, sir. Thank you, sir.
Again, more than 30, but up to 60, more than 60, but up to 90. SMA 1 and 2. Clear? Any doubt? So this was simple on the side of we saw some basic provision for the asset classifications, for the provisioning. Okay. Now we will see some specific scenarios. We'll discuss some specific scenarios with respect to the NPAs, with respect to the accounts, with respect to the classification. Why? Reason because these specific scenarios are kind of specific requirements that are required to be checked by the auditor also. Plus, banks are also required to look into for these kind of edge. These are the edge case scenarios, you can say. So we'll see. Let's take a break for 10 minutes. After the break, we'll go into these specific scenarios. Okay, let's take a quick 10-minute break. Hello everyone, welcome back. Let's continue the discussion. Now, we are going to see some of the specific scenarios with respect to NPA, deposits, credit facilities. These are the specific scenarios, or you can say, edge case scenarios which are required to be discussed. And why? The reason because we need to understand what are the regulations around these scenarios. So the moment when we are auditing, this can appear as a red flag for us. Okay. So these scenarios are kind of a, you can say, a red flag for, okay. And as an auditor, we need to highlight these scenarios. Okay. Now, for example, when I talk about basically accounts being regularized near balance sheet dates. Okay. So a particular account which is getting regularized near balance sheet date. That when I say regularized means earlier it was NPA, now it is performing asset. Everything is paid. So the term regularization or regularize, that means earlier it was NPA. So from NPA to performing asset. So when you make that account from NPA to performing asset, that is known as the regularization of the account. Okay. Now, if an account is being regularized near balance sheet date, that is 31st March, don't you think those accounts are kind of a red flag for us as an auditor? Yes or no?
Yes, sir. To show that account to performing asset, there might be some fund is flown into the account. There may be auditor need to strengthen the process to get the evidence. See, suppose 31st March is regularized, then the near immediately on the April month, whether again it's overdue is there, outer is there. That also need to check into it because it's a mere to close and report that now NPA to perform asset, there might be a chance there. Whether it's really moved from NPA to performing asset.
Absolutely. So, if an account has been regularized before the balance sheet date by the payment of overdue amount, it could be a genuine case or genuine source of funds which can be utilized. In that case, you are not required to treat the account as an NPA. But you need to check whether subsequent to the repayment, which is repayment of loan and repayment of principal and interest, whether that funds that were used for making the account regular were the borrowed funds, were the funds that was coming from any subscription to the debentures, whether these funds were coming from the person obtaining another loan. What is the source of the fund? If the account still shows the weakness based on the data available, when I talk about the weakness, that means genuineness. You are not able to identify the genuineness. At that point in time, you need to treat that account as an NPA only. So, when an account gets regularized near balance sheet date, first verify the sources of fund. Sources of funds that are used to pay overdue amount. And this particular source should not be borrowed funds. Okay, this should not be a borrowed funds. Second, look for weakness. Now, this weakness is a kind of a subjective term where you need to apply professional judgment. Look for this weakness in the account, or account data. If there is weakness, then do not classify as a performing, keep it as a non-performing. So, if weakness present, then classify as NPA only. Classify NPA, that's it. Do not classify as a performing asset. So this is for the accounts which are regularized near balance sheet date. A lot of banks or a lot of branches may do this kind of scenario to, basically maybe try to, show their good assets and good balance sheet, but that may not be the correct. So second comes is when to upgrade the account, when to regularize or say that account is no longer a NPA. So upgradation of loan accounts classified as NPA. So if a loan account is there, okay, that was classified earlier as an NPA, then you will upgrade that account as a performing asset. When you will classify that particular account as a performing asset from non-performing. I'll take your question, Sanjay, in a minute because there is something more I have to add up on this. Don't worry, I'll take it up your question. When you will upgrade the loan account from NPA to normal, let's say if there is an NPA account, how that account can become performing asset from non-performing asset, what that person has to do. Anyone? Straightforward, that person has to pay the amount. Pay the amount, remove the overdue, and make the account performing. Simple. Yes or no? But with that, there is one problem. What is the amount that is required to be paid? So to upgrade the loan account from NPA to performing asset, it is not only principal, all the outstanding or overdue amount is to be paid. When I say all, that includes my principal plus interest, both. And not only on this particular loan, on all facilities or assets. Why on all facility and assets? Because the asset classification is borrower wise, not facility wise, is borrower wise. So if a particular asset is NPA, the entire borrower will be classified as an NPA. So the asset classification is borrower wise, not facility wise. So it's all facilities, all the assets, all the credit facilities, loans, whatever taken by this particular borrower has to be performing. Then only I can classify those asset in that particular all the assets as a performing. If one facility is non-performing, all the facilities of that borrower will become non-performing. So facilities granted by a bank to a borrower or investment in all security, whatever it is, has to be treated as a non-performing if one of the facility becomes non-performing. And to upgrade that account, he has to pay all the amounts due, outstanding, whether it's principal, whether it's interest on all the facilities and assets. Now a question may come, sir, what if he is paying amount near the balance sheet date? What if we pay amounts near the balance sheet date? See, again, if he pays the amount near the balance sheet date, And if the sources are not the borrowed funds and the weakness is not there, you can allow upgradation of the loan account from the NPA to PA, performing as such. Now, there was one question, what is near to balance sheet date? What date I can take it as a near to balance sheet date? Can I take January as a near to balance sheet date? Can I take February as a near to balance sheet date? See, the term near to balance sheet date is not defined basically. But when you understand near to balance sheet date, that means somewhere very near, 2-3 days here and there from the date of balance sheet. It can be a week also. But again, it's a professional judgment. Whether you want to take a week, whether you want to take 3 days, whether you want to take 5 days. So it's totally upon the professional judgment. What is the near balance sheet date? Near to the balance sheet date. It's a subjective. And they are required to be handled with the professional judgment, these accounts. Some might take the entire month of March as a near to balance sheet date. Again, depends upon the type of asset you are looking at, depends upon the type of facilities, borrowers you are looking at. And you may have a different categories of facilities and a different requirement as a near to balance sheet date. So there is no specific and fixed answer for that. Clear? Any doubt? Okay. Now, there is something I want to talk about with respect to the temporary weakness or temporary, you can say, deficiencies in the account. Deficiencies which are temporary in nature. And there could be a scenario where there is a temporary deficiency in the account. So, temporary deficiencies in account. Now, what to do with these temporary deficiencies and what are these temporary deficiencies? See, as an auditor, we should be aware whether it's an NPA or it's a temporary deficiency. It could be a temporary deficiency, but not an NPA. So we need to understand what is the difference between temporary deficiency and NPA. See, let's say for example, when I talk about temporary deficiency, the temporary deficiency, when I say, let's say credit facilities, cash credit, overdraft, where your borrowing or your outstanding balance has exceeded your drawing limit. Now, what if the drawing limit is being calculated, it is not finalized yet. Drawing power, facility limit is being calculated. Sanction limit is being revised. So in those kind of accounts, you need to understand whether this is a temporary deficiency or it's an NPA. For example, drawing power to be recalculated or to be arrived based on current stock statement. Now, till the time drawing powers are recalculated, it may show that, okay, outstanding is more than the your drawing power or sanction limit. At that point in time, I may not classify that account as a NPA, but I may classify as a temporary account with temporary deficiencies. So banks are not required to classify these accounts as an NPA. Just because some deficiencies are there which are temporary in the nature because of non-availability of the adequate drawing power based on the latest documents. Okay. So in that case, let's say, for example, large borrowers are there. For example, large companies are there where they have multiple warehouses. So getting the stock statement, audited stock statements, consolidating them, providing to the bank then applying all the formulas to calculate the drawing power. Okay, it takes time. So in those scenarios, it should not be the case, okay, we classify this account as an NPA. There are limits that, the stock statement which is used to calculate the drawing power should not be older than 3 months. In that particular case, again, new statements are required to calculate the drawing power. So if drawing power is calculated on the older statements, the account will become irregular or NPA. And then it will be a problem. So to avoid that, they may ask, stock statement which are current and which can create a temporary deficiency in the account. If a working capital account or a credit facility account is irregular, or the drawings are being permitted for a period of 90 days, okay, or until the borrowings or or the drawing power is calculated. If a credit facility account is irregular or drawing is more than limit for 90 days or more, in that case, we classify that as account as an NPA. Okay, we classify that account as an NPA. Now, to save this kind of situations, banks have been given a kind of, what you can say, tool. So to avoid these kind of scenarios where it is taking time or something, they may provide ad hoc limits, ad hoc credit limits. Till the time they finalize something, they may provide ad hoc credit limit to the borrowers. Okay, we are giving ad hoc limit. You, as of now, work on based on this limit till the time we calculate the drawing power. But these ad hoc credit limit should be, not more than 3 months older. Means these ad hoc credit limit should be reviewed within 3 months or every 3 months, basically, from the sanction date. Okay. Again, this can be extended. This 3 months can be extended up to 6 months. If, that basically evidence is furnished that, financial statements are not available, this data is not available, can be extended up to 6 months. But beyond 6 months, no. And if this timeline expires, if it is not reviewed within the timeline, then you may call this account as an NPA. So you need to understand whether a particular account is with a temporary deficiency or an account is NPA. So simple. One, if the documents are pending because of which the outstanding balance has more than being drawing power, and drawing power is yet to be calculated based on the current stock statements because the old stock statements are more than 3 months older, you may call it a, what you can say, temporary deficiency. But if that temporary deficiency continues for 90 days, it may become NPA. Now, to avoid that, banks may provide ad hoc credit limit, but these are also to be reviewed within 3 months from the date of sanction, or in some cases 6 months, but not beyond that. If you do not do, NPA. Clear? Any doubts? Any doubt? Why we are understanding these norms? Because when it comes to the audit of a particular category, let's say you are being given an audit of the asset classification. At that point in time, auditor should be aware what classification is required to be made for this particular asset, and then accordingly you can make the appropriate reporting. Okay. Next category that I want to discuss about the advances under consortium arrangement. Advances under consortium arrangements. These are special category of advances or special category of loans. So what is consortium arrangement means? 5 banks coming together providing a loan for very big project. 5 banks coming together, they are saying, okay, let's make a consortium and then let's fund this particular big project because borrower needs bigger amount. Okay, and multiple banks come together and they are providing the funding. In this particular scenario, okay, what happens is how consortium works is that let's say I have multiple banks. This is bank 1, let's say bank 2, bank 3, bank 4, and there is a bank 5. Okay, there are let's say multiple banks and then there you have a lender. Now, what happens is when this consortium works, every banker, okay, the remittance goes to one particular bank and then it is divided into multiple banks. Same way, when the loan is given, first the loan is given to the particular bank and that bank then, becomes a middleman kind of thing to facilitate all the borrowings and everything for this particular. So every loan now will go to this bank. So loans will first go to this bank and from here then it will go to this particular lender. These are the way funds will go and this is known as the lead bank in the consortium. This is the entire consortium. When it comes to time for repayment, lender will not go and make the separate 5 payments to different banks. The payments will be made to a particular lead bank and the lead bank then will divide that payment amount. So at the time of payment, what will happen is lender will make a payment to lead bank and then lead bank will decide how much amount to be given to each of the particular bank based on the arrangement that they have in the consortium. Okay. So basically they decide then what is the amount to be paid to each of the bank. Like lead bank decide and they transfers that particular amount to each of the bank. Now the question comes is, what if this particular lender becomes the NPA? What if this particular lender becomes the NPA? How in that particular case, this amount will be treated, which is outstanding? Let's say it was an NPA account. Okay. So he did not pay anything to any of the bank. Every bank is classified as an NPA. Fine. Now, after NPA, let's say the outstanding amount, outstanding overdue, and it's a consortium. Let's take a very big number. Let's say it was 500 crores overdue for more than 1 year. Very big default. Now, out of this overdue amount, this person decided to pay, let's say, 50 crores. Decided to pay. Or let's say paid. Now this 50 crores will first go to this bank. This 50 crore will first go to this bank. This bank then will bifurcate between them. Now the question comes is, this 50 crores, how you will be determining? So let's say this 5 crore is NPA, overdue, and it is divided into different banks. Let's say here you have 100, here you have 100, here you have 50. Let's say one more 50. So 300, 200 is lying with this bank outstanding. So 200 here. Now this 50 is paid. Who will classify this 50 as an NPA? Who will classify this 50 as a receipt? Any idea? Anything? Who will adjust this 50?
Sir, based on
Because a lot of requirements.
the lead bank, based on the agreement between the bank, multiple banks, the lead bank will determine that the 50 crore. He will distribute.
Okay, now I'll tell you. Let's say I'll give you a real example. Okay, in this scenario, in an example, what happened? That this bank, okay, let's say B5. Okay, B5, Bank 5. So Bank 5 received in total, B5 received rupees 300 CR in total. Out of this, 200 was adjusted against principal and 100 was adjusted against interest. And entire outstanding of Bank 5 was removed or like paid or adjusted. Okay, so 300 was paid, 300 crores was received by Bank 5, but instead of transferring, Bank 5 applied that particular amount to entire its outstanding first, because that might be written in the agreement or whatever. Okay, we'll not go into that. None of the other banks received any amount. Now the question comes is, Bank 5, after receiving this amount, B5 regularized the account. Now you are the auditor of Bank 3. How will you classify this account? Being an auditor of the Bank 3, how will you classify this account? Simple. You have not received any rupee. 50 crores were outstanding. They are still outstanding. 300 crores were paid in tranches. Let's say into 6 tranches. Okay. And this 6 tranches were utilized by Bank 5 only. No amount was given to any of the person.
It will be classified as NPA for Bank 3.
Sir, yes, sir. So Sanjay is
Anyone
right only.
else?
Yes, sir. Actually, only Bank 5 only received the money. Bank 5 in turn did not transfer money to the bank 3. So as far as the bank 3 is concerned, still it will be classified as NPA only. The reason is money is not received and account is not regularized.
Exactly. Very good. So, by this way, when I talk about NPA and regularization, the money should come. It is not the amount received by the bank 5. It is the money that should be received by the bank 3 in their accounts. Till the time you have not received the money in your own accounts, you will not classify that particular account as in regularized or regular account or performing account. It will still be classified as an NPA. It will still be classified as an NPA for bank 3. So for consortium, advance under consortium arrangement, till the time you have not realized the money in your account, do not change the classification. Simple rule. Money must be received in the bank's account. Then only classification will change. Money must be received in bank account for change. Otherwise, do not change the classification. Straightforward. Clear? Any doubt? Okay. Now, a specific kind of scenario we will discuss, which is fraud and the erosion of the security due to fraud. Fraud and erosion of security due to fraud. Means there is a decrease in the value of security or secured portion due to fraud. How and what is required to be done? Let's say, for example, there was an account which was NPA. Okay, or let's say standard account, not even NPA. I'm talking about standard account. And you identified a fraud. There is a potential threat for the recovery on that particular account, okay, due to erosion of the value of the security or non-availability of the security due to fraud. So there is a threat of recoverability, potential threat of recoverability. Now, in this particular case, let's say, for example, the realizable value of the security, NRV, net realizable value of security, becomes less than 50% of original value, which was assessed by the bank. Because at the time of admission or at the time of last inspection, when the security was taken, let's say from that, there is a decrease in the 50% of the value. Simple. The account, such NPA. Because now I have to classify this account in NPA. There is a fraud committed by the borrower. Security has been decreased less than 50%. Okay. Now, in this case, I will not go stage by stage approach of the classification of a fraud. Now, here, this particular account will be classified as an NPA directly, and such NPA will become directly without any stage by stage classification, straightforward as a doubtful category. Direct, straight, doubtful category. Because the value has decreased, value of security is less than 50% of the original value. Now, NRV of the security is less than 50% of the original value of security. And the provision norms will follow accordingly. Let's say if this decreases the NRV of security, NRV of the security is less than 10% of original value. Because of this fraud or whatever, committed by the person. In this case, ignore security and NPA with a classification of loss asset. I will not count any secure portion in this scenario, and I will directly count this as a loss asset with an NPA. Straight classification. Because there is a fraud. Remember, there is a fraud involved. That's why I am doing this. There is a threat, potential threat for recovery on account of erosion of security due to fraud or due to existence of fraud committed by borrower. This is due to fraud. Clear?
Sir, on the first case, the
Any
less than
doubt?
50. Yes, sir, on the first case, less than 50% of the original value. NPA doubtful, which directly classified as to NPA category, is the less than how, sir? It's a doubtful or how, sir? It is under which class it will be there?
Doubtful, directly doubtful.
See,
NPA doubtful.
Doubtful. Okay. For the unsecured portion,
Directly doubtful.
give that 100% and the secured portion. For secured portion less than
Based on 1 year, 1 to 3 year, and 3 year.
No, for that we will. Okay.
Less than 1 year.
And we say it is loss assets, NPA. In case it is less than 10%. So even if he is paying regularly the amounts against these assets, still it will be considered as loss assets.
Because there is a fraud element involved. And there's a threat of recoverability. See, when I will say there is a potential threat of recoverability, reason because either he has stopped paid or there are chances he will not pay. Okay, then I will say there is a potential threat for recovery on account of fraud. For example, a person took a property loan and later on it was identified the property is non-existent. It was just on paper. There is a potential threat of recoverability. Now the fraud has came to attention to everyone. So there are chances that bank may ask the entire loan. See, simple example. If you identify that a loan was given to a person on a security which actually does not exist, will you still continue providing that loan, or will you ask the person to refund the entire amount of that loan which is given? Obviously, you will ask, okay, give us the loan back. The loan matures immediately, entire amount together, because the security which was provided is not there. Okay. And the norm says that way because earlier it was a secured loan which was given, housing loan, but there is no house in front of that. Now this has to be given as a personal loan. Plus the person did a fraud. There's a question on the integrity of the person. So the entire amount is required to be recovered immediately. That amount becomes mature immediately. And once the entire amounts become mature immediately, there is by default, there is a potential threat of recoverability. Because earlier that person was paying EMIs, somehow he was managing by doing the fraud, but now I am asking the entire loan again to be paid back immediately. Definitely, it will create a potential threat of recoverability.
Here the question is that who will classify as in this account as NPA? Whoever identify first. For example, if the bank is identifying first, or internal auditor, or external auditor, or some other inspection from the RBI, whoever identify first this condition, they will classify this account as NPA. How, sir?
See, doesn't make a difference. Let's say, for example, internal auditor classified as this fraud. Internal auditor classified, he will mark this account as doubtful. he will ask bank to make a provision. Simple. If external auditor does, they will ask a bank to make a provision in front of that. Whosoever will do, bank has to make a provision by complying the norms. These are the what I can say regulations, prudential norms. The bank has to follow. If bank will not follow, then we have to qualify. We have to report that the bank is not following prudential norms.
Okay, sir. What is the valuation criteria, sir? The asset or collateral, whatever given as a security, what frequency they will value the NRV? As for the bank norms, sir.
That depends upon the type of security in the account. It is not straightforward. It's depend upon the type of security.
Okay, sir.
Type of loan, type of security, amount of loan, a lot of things are there in that. Clear? Any doubt? Any doubt?
No, sir. Clear, sir.
Okay. Now, based on this, based on whatever we have discussed, the provision, asset classification, there is one more area that is we need to discuss about. It's an income recognition. Okay. Income recognition is very important for the bank. What to recognize, when to recognize in case of accounts. So there is an income recognition policy. Or income recognition regulations as a part of prudential regulations. Basically, these income recognition says that, again, on a similar lines, if that is an NPA account, income should not be taken into unless and until realized. NPA, do not recognize income. Simple. Do not recognize income. Do not charge and take income account on interest on any NPA. When I say income, that will be interest for the bank because that's the main income for the bank. Okay. And this applies to government guaranteed accounts also. So if there is an exports credit, although I will not make a provision, but I will also not recognize the income. So this applies to including government guarantee accounts. Okay, so simple. I may classify that as an NPA. I may make a provision. I will not make a provision on that particular account because I know I am going to get that particular credit cover which is there. But I am not required to recognize income on that particular government guarantee account. I have to classify NPA. No need to charge provision, but do not recognize income. Clear? If any income recognized, if any advance, including any particular income recognized in past period, which is yet to be realized on NPA, that has to be reversed. So income recognized, not realized, and not realized on NPA need to be reversed. You have to reverse that particular income. Now there are moratorium, okay, on the payment of interest. See, now there are loans where there is a moratorium period given. For example, do not pay interest for next 2 years or do not pay interest for next 1 year. There are special type of loans given, moratorium, to either employees of the bank or to specific category of people. Okay, specific
I think,
sector of.
I think during the COVID time, they
Mhm.
given the moratorium for 3 months, 6 months like that.
Yeah. So in that particular period, interest does not become due and it cannot be classified as an NPA. So in moratorium, if something is not becoming due, you cannot classify that as an overdue. And if it is not getting overdue, how can you classify that as an NPA? So in that particular period, with a moratorium, interest usually does not become due or do not become due. And hence cannot be classified as NPA on the basis of overdue interest. Okay, I cannot classify as a overdue interest. The payment is required to be made only after it becomes due, and this becomes due once the period gets over. Okay, now coming to the part on the interest. Am I required to record interest in that particular period? See, in moratorium, payment may not become due, but basically, am I required to recognize the income or interest income in the books of accounts? So yes, in this particular case, I may recognize the income. That will still be counted as a standard asset. So during this particular period, income will be recognized, but it will not become due. There is a difference between becoming due and recognizing the interest. So NPA can only become in this scenario once it becomes due. And if it has become due, in that case, whatever interest I have recognized as an income, I have to reverse that. So if interest recognized and overdue, okay, after moratorium period, okay, need to be reversed if account becomes NPA. Okay. Now I will do a star mark over here. This is the condition supplied. That means subject to capitalization of interest. Which is not required to be reversed. What is capitalization of interest? Capitalization of interest in moratorium period, a lot of banks provide the facility that whatever interest will be there. See, moratorium is not something that interest will not be charged. Interest will be charged, but you are not required to pay. You pay after the period gets over, either in equal installments or that amount will be added to your loan account. Sometimes they increase the loan amount by that particular amount. That is the capitalization of interest in the asset. If there is a capitalization of interest in the asset itself, that the interest now becomes part of the loan and that you have to pay as a principal, that is a capitalization that is not required to be reversed. If that interest is recognized as an income and it is not capitalized, that is required to be reversed as per the norms, that is if the account becomes NPA. Clear? Any doubt? Any doubt? Okay. Now the question comes is why we are all going and basically looking into all these regulations. What is the purpose of these regulations? Why we are looking into all these things? Okay. Reason because here now we will understand that how and a reporting is required to be done for the banks. As an auditor, what kind of reporting we do? As an auditor, what kind of things we report? Okay. So now we will discuss some of the reporting requirements from the point of view of auditor. Because based on this, now we will understand that how auditor actually reports the matters. How many of you have actually seen LFAR report?
I have seen, sir.
Anyone?
I have part of that statutory audit of banks, sir. I have done few banks, State Bank of India, Union Bank of India, S12, Canara Bank.
Now, so basically, when I talk about audit of banks, okay, so there are different kind of audits. Either you are a central statutory auditor, either you are a branch auditor, okay, either you are auditing the large irregular critical accounts for the branch as a branch auditor. So what is the role that you are doing? What is the audit you are doing? Based on that, the reporting requirement depends upon. And there are other areas also that as an auditor we are required to look into. For example, information system. For example, going concern and liquidity risk. So we will discuss now all those things with respect to the reporting part. Okay. With respect to the reporting part, now we will see that how reporting is actually done by the auditor. How auditor actually reports the things. Okay. And based on that, we will be able to understand like how things will be, now will be, as an auditor, we need to do area by area because we know the provisions now. And as an auditor, we will now understand how to audit those areas by knowing the provision. So quickly, we'll go to the annexure 1 first. Annexure 1 basically talks about the LFAR for the central statutory auditor, which is reported to the management of the bank. Okay. Now, again, the detailed forms are different, which are there on the online portal of the bank. This is the indications of the area which is there in this particular format. It's an indicative. The actual reporting may change, which is there, it keeps constantly changing, which is there on the portal. But again, this is the this is the now online basically form which is filled by the auditors. Okay. It is either yearly or it may happen that which is required to be done by the 30th June every year. So there is an online portal of RBI where you need to fill up the form, and there are things which keep on changing. But what you report as a central statutory auditor, you report on the loan policy. Loan policy means how the loans are given by the bank. What is the policy that bank is following with respect to the loan? For example, what are the interest rates which are charged? What are the basically you can say exposure norms? Exposure norms that in to whom the loan is given, whether it is secured, whether unsecured. What is the things or documents which are looked into before providing the loan? So before giving the loan, what are the requirements as an bank is checking before providing the advances? What is the things that banks are looking into? We as an auditor go and check whether the policy which is followed by the bank is appropriate, whether the policy which is followed by the bank with respect to the loan to be provided to a particular person is appropriate. Now, let's say, for example, you are the auditor. Okay, hypothetical example, you are the auditor. What you will check when it comes to the loans or advances that are provided by the bank? Anyone?
Loans, sir. First, we will see the
What
credit
will,
sir, we will see the credit worthiness
credit
of
worthy?
the credit worthiness definitely see, and based on the different loan category, there will be the procedure and policies laid down. What are the documents to be obtained? What are that points? What are the details to be received from the borrower? Those complaints to be checked out.
Okay.
And the DOA, approval authority, sanction limit, and what are the security to be obtained before, what is the dispersing term, what is the credit rating, credit limit, and is there any existing default is there, and see all these things. What is the maximum amount we can loan can be given? What is the minimum amount? What is the duration? Like the collateral is adequate or not? And before dispersing, whether there is a maker checker concept, whether all the document received or not, what's the covenant and non-covenant, like that, in all the document, whether it is gathered and put in the file and safeguarded. These all things to be checked out.
Okay. Yes. See, again, whenever I say basically things are required to be looked into, basically we have to think from the point of view of audit. So in case of audit, there are two components, two type of testing we do. Which are those two type of testings?
Test of control, test of details. First, we will do.
Exactly. So when I talk about so when I talk about doing the audit of a particular area, think from both point of view. Are there any controls which are there, which are and like kept by the bank in that particular area? For example, a control that loans should only be provided once the creditworthiness of the borrowers is checked. So the controls, whether the controls are there around that area, whether there a control that loan can only be provided once the necessary documents like agreements, like hypothecation documents of the property are executed by the parties. That there is a sufficient margin kept in the security. For example, you are giving a loan of 100 crores. You will not take a security of 100 crores. You will take a security of 120 crores or 150 crores. You will keep a margin that tomorrow, even if there is a decline in the value of security, still you are covering your entire loan amount. So what is the margin? Is there a margin as per the directives? Whether you have received the security before disbursing the loan amount, whether that has been verified by the officer, responsible officer, whether the securities are registered in the name of bank. In case of drawing powers, whether the additional temporary limits which are assigned are reviewed every 90 days or within 90 days. What is the whether there is any account which is exceeding the sanction limit already and you are providing new loans. So this is kind of the controls that are required to be kept by the bank on the loans. Once I will check the controls, on the basis of that, I will then perform the different audit procedures. So this is you can see page number 14.18 in your study material. These are the controls or areas. As an internal control, you will verify for loans and advances. Okay. So some internal controls that the bank typically implement on these areas, or we are required as an auditor to verify before we proceed for the test of details. Creditworthiness, agreements, sufficient margin in the security, then joint custody of two offices of security, security requiring registrations, then drawing limit. Remember, additional temporary limit, ad hoc limits, more than 90 days that we saw the provision. Okay. So sanction limit or drawing power or like amounts exceeding the sanction limit or drawing power, whether they are appropriately reviewed. Okay, so all these things are there as a control that the bank should have. Now, once I verify the control, I will have a comfort. Yes or no? I will have, okay, whether I get the sufficient and appropriate audit evidence from the control testing, or I need to test much more detailed substantive testing. That will decide my audit approach for the advances in the substantive testing. In the case of substantive testing, I will take up amounts which are outstanding on the balance sheet date. That will be by population. Okay. Then in that particular case, what I will do, I will first of all evaluate the internal controls. Once I will evaluate the internal controls, now then on the basis of that, I will perform the substantive procedures. Substantive procedures as in, I will check whether installment are being paid, are correctly entered into the system. EMI, rate of interest, tenure of loan. You might be saying that, okay, sir, this is very small thing, rate of interest. Why we are required to check for the rate of interest? The reason because we only discussed one particular direction. That's the prudential norms. But when I talk about bank, I will show you something more. I will show you directions which are relevant from the point of view of interest. So there is the interest related directions, interest rate that are required to be charged on our account.
Yes, sir. If the interest is not changed to the interest, if not updated in the system, then there will be a lot of revenue leakage.
Yes. So what interest is required to be charged on a particular account is there, like interest rate framework, like what is the account, what is the loan, what rate you are charging, floating rate, fixed rate, all these are given in the directions. Interest rate on domestic saving, interest on overdue domestic deposits, periodicity of payment of interest on domestic savings. This is savings. But again, similarly, you have different type of, deposits are there, and there are separate guidelines on the loans. So there are guidelines on the interest that you pay and that you collect, and whether the same guidelines are being followed for the interest. And by following, I mean whether you recognize that particular interest rate in your system. On paper, you are charging 8% as per the guidelines. But when it is time for collecting or recording, your system is collecting or recording at 6%. Document is showing 8%, actual is collected and recorded 6%. So whether say core banking system, whatever is there in the document is there in the core banking system. As I said, facilities are tagged borrower wise rather than the account wise. Now, how will you classify all the borrowers wise facility? So there was a concept which was brought into with the customer ID. Each customer will have now a customer ID, customer CRN. Okay, so you, for your accounts, you might see you now have a CRN, customer relationship number. By this particular ID, customer ID or CRN, all your bank facilities are tagged under one umbrella. So if one goes NPA, entire umbrella goes NPA. So whether this tagging is appropriately done, whether the large advances are identified appropriately, whether this category SMA1, SMA2 is being followed. So now you know what this categorization is, this SMA1, SMA2, whether this is followed or not. Okay, so this is something you do at testing. Now this testing I'm talking about substantive procedures. Okay, you identify whether is there any adversely commented accounts, kind of loss asset, any restructured accounts. There is a restructuring requirements. Okay, whether there is an NPA within 12 months of giving the loan, quick NPA, quick, these are the kind of loans which are kind of a shady. Like you give and from within the 12 months itself, it becomes NPA. You verify the accuracy of interest being charged because you are not required to charge interest on the NPA. Okay, you perform the analytical procedures. These are some substantive audit procedures that you perform on the advances, loans, as an auditor. And that's what you are required to report as per the LFAR loan policy. That whether compliance to the instruction issued by the interest rate, exposure norms, statutory, other restrictions, updation of the policy in the systems, all those things you are required to assess the creditworthiness, adequacy of the information and data available with the bank to perform the creditworthiness, quick mortality cases like becoming NPA within 12 months. Within 12 months. Just now we saw this particular part.
Yes, sir. Quick in NPA.
This was a quick NPA. Examine the clear early mortality accounts, that NPA within 12 months of its sanction. So this is something as an auditor we are required to report, and we can only report when we are aware about the matter. What is the scenario? Quick mortality cases. If you hear for the first time, you will not come to know. But if you know the provision, then only you can do the reporting. Sanctioning and disbursement. Segregation of delegation of power and segregation of duties. That whether the sanctioning is happening appropriately or a particular analyst level person in the bank is sanctioning loans worth of crores. Who is sanctioning the higher amount of loans? Whether there is an authorized limits under which the sanctioning happens. Documentation. Remember, agreements, all those things. So whether appropriate documentations are there or not. Creation of charge in favor of banks, registration of securities, okay, renewal documents. Is there any, like renewal of documents means? Remember in drawing power,
Yes,
3 months
sir.
older,
Yeah,
not it should not be more than 3 months older.
if the account is not received more than 6 months, then it will be classified as NPA.
Yes. So renewal of documents, whether appropriate renewal is there or not. Then reviewing, monitoring, post-sanction follow-up. This is after sanction. Is there any red flagged accounts? Is there any account which requires special focus? Early warning system. What is early warning system? SMA. Special mention accounts. That's an early warning system. SMA classification. Is there any SMA classification done appropriately? Physical verification and inspection of stock or machinery or anything. So all these things as a central statutory auditor, we are required to look and report for the particular bank. This is just the one area with respect to the credit risk area that we are talking about. There are multiple areas that we will now discuss, because the first thing was to understand the provisions from where and it is coming, and then to deep dive. For example, now we will, let's say as an auditor, we will comment upon the asset quality, SMA. Now you know what is SMA. Substandard, standard, doubtful, loss as per the norms, prudential norms. This is IRAC is nothing but income recognition and asset classification. Income recognition and asset classification norms. That's a prudential norms. And that should happen without manual intervention. Correct recognition. Adequacy of provision. Provision on assets. Based on the percentage we saw. So whether it is happening appropriately, upgradation of the NPS, whether procedure followed by the bank in upgradation of the NPA is appropriate or not, or is there any accounts which are being regularized near balance sheet date. So all these things are required to be reported by the central statutory auditor. And as an auditor, we should be aware how to report this and how to audit this. Clear? Any doubt? Any doubt?
No, sir. Clear, sir.
Okay. So if no further doubts, what I propose here is this lecture was specifically to make you, familiar with the bank provisions, bank norms and regulations, which now we will understand how to report. In the next session, we will do a deep dive on the reporting part, the way we did for the NBFC. Similar lines. First, we understood the provisions which are relevant from the reporting point of view, and then we deep dive in the reporting areas. Similarly, what we'll do now is we will do a deep dive in the reporting and auditing areas. How to audit and report different areas of the bank's balance sheet, performance, operations, all those things. Okay, and we will go through area by area. Okay, and we will discuss for the central statutory auditors, branch auditors, and the large and critical accounts. I will also bring up the public report that is available for the discussion purpose, because it contains a lot of reporting parts which is done as a part of the management. Management does a lot of reporting over here. But as a management, as an auditor, we have to audit this particular reporting which is done by the management. I'll just show you one more thing. So contingent liability related reportings with respect to the banks, and small and medium enterprise related reportings with respect to the bank. There are multiple reportings which are required to be done by the bank. We will discuss when we will, go and perform a deep dive with respect to the reporting part by the management and how auditor audits this particular part in the next session. Okay. So I want you guys to go through the chapter in detail. It's the study material in detail, because in the next session I want you, if you have read a particular portion, that how to audit, and when we will discuss, you will be able to correlate with that. Okay, so please read the chapter before the next session, and then we will discuss on the reporting part. Clear? Again, any doubt? Any doubt
No, sir. Thanks.
before we close the session? Okay. If no further doubts, then I propose to keep the session till here. Thank you guys. Thank you for participating in today's session. I will meet you in the next one. Thank you.
Thank you, sir. Good night, sir.
Thank you. Good night. Yes.
Thank you. Thank you.
Thank you. Thank you. Good night.